Hi everyone. So this is the third in a series of interviews I'm doing ahead of DealCatalyst Specialist Lender Europe Finance Conference, which is coming up next week, November the 6th. I'd encourage everyone to register. It's going to be a super interesting event. I have here with me Jason O'Brien, who's going to be speaking at the conference next week. Jason runs Atlas SP Partners in Europe. It's a famous firm, but kind of a new firm. So I'm just going to pass to Jason to let him introduce himself and Atlas, and then we'll get into it.
Thanks, Owen. I'm Jason O'Brien. I run Europe for Atlas SP Partners, which is the spin-out of Credit Suisse's securitized products business, which is majority owned by Apollo, which has been set up to be a specialist origination and financing firm focused on asset-based credit. But excited to talk to you about the market and sort of Atlas as a whole and sort of get into it a bit here.
Super, great. So I'm going to kick off with, I guess, a question that's very thematic for the conference next week, which has a lot of private credit stuff around it. Is there a difference between asset-backed private credit and regular way securitization?
Yeah, I think, Owen, private credit is such a large and growing category that it's worth differentiating what's happening in the market. Private credit and direct lending have sort of gone hand in hand for a while, with funds raising significant capital to help corporates borrow in ways that either didn't fit the risk appetite of banks or didn't fit the traditional leveraged finance model of bringing a bond or a loan to market. This has been hugely successful. The direct lending market has not replaced banks, but rather worked alongside banks to develop a wider range of lending options for borrowers that ultimately, I think, delivers a better allocation of risk to the right types of capital. That same transition is what we're seeing now in securitization and asset-based private credit. The creation of Atlas SP Partners via the spin-out Credit Suisse the securitized products business is quite possibly the first large-scale creation of an asset-based private credit organization platform, which allows LPs to access markets that have existed for a long time solely on banks' balance sheets. Atlas and other asset-backed private credit lenders won't replace banks, nor will they replace public securitization issuances, but rather I think they'll work hand in hand to develop alternative sources of borrowing for either non-bank originators, financial sponsors, or corporates who need alternative lending solutions. And ultimately, our hope is that will increase the entire market, both the private market where we've seen significant capital growth, but as well as the public securitization market overall.
Okay, that sounds fantastic. I'm optimistic if you're optimistic. Perhaps a little less optimistic in tone. Over the past couple of years, we've seen a major rising rate cycle that's hit the specialty lending sector, I think, particularly hard. What exactly have you seen on that side? How has that rate cycle affected your client base there?
Yeah, so I think higher rates, which have inevitably been a result of higher levels of inflation, have hit the market hard. And we've already seen that in commercial real estate and certainly at the higher borrowing cost levels of corporate and SME lending. I think my concern and where I'm spending a lot of time watching things is on the consumer. Okay? I think we've seen higher energy costs, higher costs of food and other staples sort of for the average household, on top of higher borrowing costs, both at the mortgage level and the consumer loan level. And I think at least in Europe, we haven't seen that performance deteriorate at the consumer level. And we've seen specialist lenders contract their lending criteria as sort of, is prudent to do in this space, given the combination of, a more difficult credit environment going forward, as well as the fact that their cost of capital has increased and the availability of VC funding, which was not profit-driven, has dramatically decreased. So with that, I think, we are very conservative with the unsecured consumer and what that means for losses and arrears and defaults picking up going forward. But that being said, I think, the private lending market, the specialty lending market is going into this eyes wide open. I don't think anyone expects the performance and fundamental government support that came from the COVID era to exist in the next 2 to 3 years. And as people adapt to the new funding model, I do think a tighter credit box with sort of some really difficult sort of affordability constraints is going to be the norm. And I think that's true both from funders, but also from platforms who are looking to raise equity capital from a new type of capital base, which requires profitability at the platform level too, rather than just VC stuff.
Mm-hmm. Sure. I mean, in that difficult environment, where do you see the best balance of risk reward for yourselves as a financing counterparty?
Yeah, so Atlas is primarily a senior financier, so I'm predisposed to highlighting the senior part of the capital structure as being attractive and defensive, going into this murky macro environment. But in some ways, it might be easier to talk about sectors where I think value remains.
Sure.
And fundamentally, throughout my career, the liquidity and resilience of sort of residential real estate continues to offer attractive, defensive returns. And I think for balance sheet that maybe isn't, the 100 basis point over money that we see from some of the continental banks, there's ways to access that risk that is a little bit more yield enhancement while still maintaining the credit risk and the fundamentals associated with residential real estate. So at Atlas, we see that in second lien mortgages, we see it in bridge lending and rent to own products. I think separate to that, sort of renewable energy has proven to be a focus for our global business, both as a consumer asset class, but increasingly on an institutional scale, where we see significant growth in the sector. That's been driven out of our US business, but we see Europe bringing renewable energy outside of just traditional infrastructure investors and into the securitization market. And then finally, I think it's, there are asset classes which have strong, steady streams of cash flows, which are potentially uncorrelated to traditional markets. We've been successful there and continue to invest in our franchise. So we think of things like intellectual property. We've publicly been out with a number of music securitizations, which we're quite proud of, and sort of other illiquid corporate receivables, where in a zero rate environment, we saw a lot of large corporates or SMEs not needing to diversify the type of capital and type of borrowing they were able to access given low rates all around. I think in this environment, as a senior financier, we're able to offer attractive lending rates, even to corporates where they have significant asset bases, to allow us to have creative and innovative financing structures.
Sure. So that unsecured borrowing cost goes up, and there's a space for you guys kind of down there. Sure.
Exactly right. Yeah.
So that's the good. Are there any asset classes that are particularly concerning to you right now? There's a lot of noise about commercial real estate and valuations on that side.
Yeah, and I think, when I try and tell my team, and I think when we talk about risk, any trade that you're trying to do today at yesterday's prices is a concern. And I think in Europe in particular, when there has been distress or disturbance in any individual market, whilst North America and some other markets tend to fall quicker, sell out, and sort of regroup and restart the market, Europe tends to go very illiquid and very stagnant. And in that type of an environment, it's easy to forget that cap rates have gone up, valuations have gone down, and borrowing costs have gone up. So commercial real estate, if you're still thinking about it at yesterday's prices, either on old valuations, old LTVs, or old credit metrics, could be a dangerous place. And there's certainly a lot to work out there together. I think that being said, looking at these type of assets with eyes wide open, provide opportunities. And I think what we'll see in commercial real estate, which is sort of indicative of what we think is going to go on in a bigger risk environment, is that we're going to see deleveraging. We're going to see banks retrenching into their sort of more traditional home markets at lower LTVs. And that should create opportunities for Atlas and other alternative providers of capital to take prudent risks, even in some of these sectors where we do think there's still more problems to come before we see sort of a rebound and stabilization.
Sure. I mean, the banking system was something, I really wanted to touch on. I mean, obviously your former employer and a few regional institutions have had some pretty well publicized difficulties this year. That we've already seen that create some opportunities, portfolio sales in the US. Do you think that kind of process has fully played through, and what read across is there from the US regionals to kind of a European context?
Yeah, so what little hair I do have left is gray, Owen. So I did obviously was at Credit Suisse recently, and I had the pleasure of being at RBS, and I remember going home to my wife and saying, on Monday, either we're going to be working for the government or the doors are going to be shut. And I think both those situations and some of what's happened in the US regional bank space has been driven by deposit flight and sort of the lack of appropriate asset liability or matching some of those banks. In my opinion, despite what we've seen in the press of sort of Metro recently, I think European banks have a relatively stable funding base, although those costs might go up. And we've seen that compression with deposit rates increasing as the sort of demand for deposits across banks increases. The stability of both personal and corporate deposits remains strong, and the overwhelming government support from whether it be the ECB, within the UK or the regional European governments is still there, watching the banking sector sort of very closely. So personally, I'm not overly concerned about overnight bank runs and flights. However, I think there is a flight to quality and a view that banks need to retrench into their core market, whether that be geographically or risk-wise. And we've seen portfolio sales come from European banks, we've seen them come from US and global risk, and we expect to be able to continue to see that going forward. I think it's one of the reasons that Atlas is very excited with where we are today, to be able to have the understanding and expertise from a management team that spent decades at European banks. But then to be able to utilize capital that's differentiated from those banks, work alongside them, and be a home for capital and risk where, it doesn't suit banks anymore. I think, in fact, one of the sort of transactions we think proved the value of our platform very early on was in that US regional banking crisis, where we were able to act very quickly and speak for billions of risk from one US regional banks at a time when banks weren't willing or able to sort of make that commitment. And I think as the private credit lending space increases, alternative cost of capital, some of which with more long-term LPs, more long-term investors, can play an important role in taking away the reliance on deposit funding from banks to sort of ensure that's the only source of funding.
So you can kind of do what a bank does, but without the bank funding model.
I certainly hope so.
You touched on this earlier, the need for fintechs to be kind of more profitable, or that VC funding environment being a bit more squeezed. How has that affected your business, your clients, your portfolio? What are you seeing in terms of change of behavior from those platforms?
Yeah, I think the traditional VC model, and I appreciate the irony of a senior debt guy talking about how VCs operate their business, but traditionally they're very focused on growth and with a low focus on short-term profitability. And because of that, most of the platforms were very driven to that extent. In fact, we financed a great number of platforms who had very low levels of profitability because the capital was continually revolvingly driven into the business to create growth, either in one asset class, multiple asset classes, or in most instances across jurisdictions. With the VC money drawing up and certainly favoring an asset-light model, what we're seeing now is that a lot of our clients are focused on short-term profitability. And we as a senior financier are equally focused that the platforms we finance are well capitalized enough to continue and work through any sort of credit micro deterioration that we might see in the short to medium term. Because of that, I think the credit box has been tightened. The willingness to absorb defaults at the platform level, set to gain growth, that's really diminished. Similarly, I think we've seen a lot of platforms trying to transition towards forward flow, right? And that forward flow allows that platform to exist on a capital light model, which has less need for VC or equity capital growth money. However, at the same time, it sort of tears away at that alignment of interest that at least me as the senior financier like to see. That being said, forward flow works very well for insurance companies. We've been involved in situations where banks themselves are participating in forward flow with non-bank originators. And I think what this will ultimately lead to is a consolidated industry where we will have less platforms than we did when VC money was pretty easy to come by. That'll be through consolidation. That'll be through some retrenching of products where some platforms focus in on what they were truly good at. And I think we will see some exits from the industry. And as much as on a very personal level, I never like to see anyone sort of leave the market, maybe that's what the current credit environment needs, where we need more champions in sectors and countries that allow them to take a bigger market share and thus achieve that profitability at scale.
Sure. I wondered if we could quickly talk about kind of Atlas itself. Again, we've touched on some of these points already, but yeah, how does your model differ from the traditional investment bank? And why should if I'm an originator, if I'm bought some assets in a forward flow, why should I come to you for funding rather than the street?
Yeah, so Atlas SP Partners is all about speed, execution certainty, and capital structure flexibility. I think we like to call ourselves a strategic partner of choice. We look to originate high quality investment grade assets and deliver bespoke and reliable solutions to institutional borrowers and investors. I think we sit as an alternative to traditional banks. In some instances, we partner with banks on sort of a number of situations, but we don't see ourselves as replacing banks and the important role that they play in the transaction. We talked about the banking crisis and what we were able to achieve with the regional banks in the US. But I think, Atlas is not a new idea. The management team here has been together for over a decade. We have combined hundreds of years of experience in the securitization market. And we have very deep relationships where we've worked with most clients, although with a different, corporate banner behind us for a long time. So we hope that the fact that we can bring these differentiated pots of capital to market, with a very deep bench of strong and skilled players, it's something that sort of appeals both to the non-bank lending sort of fintech platform market, but as well to the traditional sort of financial sponsors, hedge funds and PE firms that we've worked with for years.
And has that model kind of evolved? Has the basic proposition kind of been refined and tweaked since you guys took down the old banner and raised up the new?
Well, I think the primary difference is that the view outside my office is much better since I've left the wharf, and we're located in Shard here in London. Look, I think the experience from the strong leadership team that's been together and the relationships that we've built up over years and years remain the same. We have the added benefit of being majority owned by Apollo, which is obviously an immense institution that has a great deal of experience and relationships globally, and that certainly helped us in numerous avenues that we're working through. And the flexibility of our capital has increased. I think a lot of the transactions that we were working on at Credit Suisse continue to be focusing for us, and it's unsurprising to hear that we continue to work with the same clients. But almost on a weekly basis, we're continuing to innovate and broaden sort of the opportunity set that we're looking at.
Super. Look, that's great, and I hope there's much more to come from you guys in the years ahead. I'm sure there will be. Look, thank you very much for joining me, Jason, and yeah, see you next week.
Thank you. Looking forward to seeing you next week, Owen. Appreciate it.